Hello, everyone. Thank you so much for joining us today. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. And let me pull up the rest of this just a second here. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We are thrilled to bring you today's educational presentation. And those of you who have been to our webinars before may recognize that we have some of our same moderator and speaker back to talk about some of the ins and outs of selling your business. And we want to remind you that attendees are on mute, but please go ahead, and if you have a question, you're welcome to ask the question using the chat function today. If we don't have a chance to get to your question, make sure to leave your phone number as well, and we will make sure that someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's guests. Our moderator today is Andrew Jensen. He is a senior wealth advisor, director of alternative investments, and investment committee member at Zermatt Wealth Partners in San Diego, California. Andrew operates as a fiduciary and takes a top-down approach when formulating a client's long-term wealth strategy. Andrew augments his wealth management process by working with carefully vetted estate planning, accounting, investment banking, and insurance experts to harmonize each client's entire financial picture while mitigating risks which could derail a client's objectives. And our presenter today is Kirk Mitchie. Kirk is the managing partner of Candor Advisors, consultants to founder-led businesses contemplating capital events and value enhancement. All founders eventually need to transfer ownership or control of their successful businesses. Candor Advisor ensures entrepreneurs optimize those outcomes, minimize taxes, and achieve their objectives for sustainability, liquidity, and legacy. Mr. Mitchie's areas of expertise include transaction advisory services, mergers and acquisitions with emphasis on founder-led businesses, corporate and family office governance, capital raising, private equity, corporate strategy, and succession planning. His combination of investment and business experience inform his ability to help entrepreneurs navigate complex entity, family, and legacy decisions. And Kirk, I'm going to go ahead and turn the time over to you now. And we're excited to hear what you have to say.
Well, thanks, Marche. Good to be with you all, and excited to dig into this. For those of you that have been on one of our prior webinars, or for that matter, for those of you who are kind of familiar with the M&A process, the sale of businesses. Apologies for the redundancy of some of this, but we thought that it might be useful before we dug into, kind of putting together the right deal team, which is sort of the third in a series of, webinars we put on, the first of which was kind of about the M&A process for founder-led businesses. The second was kind of the alternative to a traditional sale. And then, of course, this one we're going to dig more into kind of who the players are, who's necessary, who's not so necessary, how to avoid mistakes, how to make sure you optimize your outcome. And so just to kind of level set or refresh on the process, there's going to be an internal and an external deal team, depending on the kind of process you go through to sell your business. And so some of these decisions are going to happen well before you actually, go to market, right? Go to market is suggestive of the idea that you're going to retain an investment banker or on your own go out there and try and sell your business. And that presumes that you've already developed some objectives about what you want to achieve, what price you're willing to take for the business, what you think you understand about the terms that are going to be offered, which then will go into the indications of interest. Those are, usually, 2 to 3 page documents, non-binding, that kind of give a range and an idea of what somebody might pay for your business, to a letter of intent, which, while also non-binding, really forms, a lot more specific guidelines around the price, the terms, your responsibilities through due diligence, and then what's expected of you after the sale. And then, once you've co-signed that letter of intent and you're in some period of exclusivity with your buyer, getting through due diligence, right, which is invasive and oftentimes feels accusatory and is a difficult process even under the best of circumstances, because the buyer's trying to make sure they're not making a mistake and that they're getting what they're paying for, and that they're understanding all the potential risks in the business. And you, on the other hand, are feeling defensive about that which you've got to show them, and are worried that they're going to find something that causes them to change their mind. And you've already in your head started to spend some of the money that they were going to, offer you to buy your business. And so, diligence is tricky, and it's probably one of the areas where you need, a professional advisor or somebody with some experience the most. And then closing, which seems like it'd be an easy thing. You just get a wire into the bank account, but most transactions have different terms around them. And between signing and closing, there are usually a few things that have to happen. So all of this, is kind of is part of every single deal. And in fact, Marche, if you want to go to the next slide, it kind of leads us to how to think about, building your deal team. If you've hit the point where, you've already assessed your why for potentially selling or transferring control of your business, which could be, you're ready to exit, you're ready to retire, or you want to take some chips off the table and start to, work less, or you're burnt out, or you don't want to go through another recession, or you can't stand your partner anymore, or, you're getting pressure from some other area in your life that causes you to want to do less of this and more of that other thing. All those things would be valid kind of whys to get you to, when and how you're going to sell your business. And it's important to understand, kind of what's driving the sale of your business, because it's something that's not only going to impact who's on your deal team, but it's going to impact who your ideal buyer is, and then what your necessary terms are for doing the deal. So who should be on the deal team, who absolutely has to be on the deal team, and then who's optional for the deal team. So why don't we dig into that a little further? First of all, your internal team, and I'll for the founders that are on the call, I will tell you that there are a couple of mistakes that many founders make that are understandable, but they can be devastating. One of them is to argue with the market about what your business is worth. Having expectations about what you think the market ought to pay for your business is I'm not saying that you shouldn't have a sense of what your business is worth or what you need to get to be willing to sell it, but the market's going to decide what your business is worth. So that's thing one. Thing two is letting too many people in on the fact that you're selling your business. You definitely don't want to tell customers. For obvious reasons, you don't want to tell competitors. And for some less intuitive reasons, you don't want to tell your employees. that you might feel like, you're transparent and you want to be authentic, and so you want to let everybody in on it. Trust me when I tell you that what that is going to do is cause a bunch of even your best people to start updating their resumes and start looking around for jobs. And that could create a problem for you when you get to due diligence. And if you find yourself in the position of having to assure your people that you'll take care of them once you've sold the business, you might be creating a legal liability, which is even more problematic. So you do need to have an internal deal team. You do need to read at least one, maybe two people in on the fact that you're going to sell. And they should be, first and foremost, your financial person. If you have a controller or CFO, that is the most natural person to include in on things, because they're going to be kind of a locus point on the buyer's interest in getting more information about your business. And you're going to be presenting your financials, recasting your financials, revising your financials, working with outsiders on your financials. So you need to nail that piece. Operational is probably more you, but depending on the size of your business, you might have to include a few other people. Typically, when you start to include anybody beyond the financial person, you're going to want that to be limited to people who will go with the sale over to the buyer. Because these are people that you may well incent to stay along. The buyer is probably going to incent them to stay along. And they're probably going to be involved in due diligence. So in that case, it does make sense if you have a chief operating officer or president or, someone who's kind of your second in command beyond the financial person, that person should probably be involved. The support side here, I don't mean, kind of clerical, but look, if you have an administrative assistant or somebody that handles a lot of kind of the the kind of non-value add stuff that you work on, but still critical things that you need to be able to pull up, like HR files, legal documents and things like that, you're going to want to include that person too. Let's talk a little bit about the external deal team. So here, the most important person to have in your transaction is an experienced M&A attorney, not just a corporate attorney, and definitely not your estate planning attorney, not necessarily a tax attorney, and maybe not even just a general business attorney, but somebody who has been through the process of selling companies and maybe buying and selling companies, so they can give you a sense of which terms and conditions that your buyer's putting forth and which things that your buyer's asserting or asking for are reasonable based upon their experience, not just their legal knowledge, but their specific experience in working in this area. So M&A lawyer, if you do nothing else, if you take nothing else from this call, an experienced M&A lawyer is the most important member of your deal team. Secondarily, especially if you're going to do an external sale, at a time like this when there's a lot of money sloshing around to grow by acquisition, there's a lot of private equity firms looking to put money to work. There's a lot of strategic buyers that want to acquire geography or different products and services by buying businesses like yours. You're probably going to want to have an investment banker or a transaction advisory firm involved in the deal. The investment banker is someone who can create some competitive tension and maybe drive prices higher and include more buyers in on the bidding to give you more options. And maybe you don't want to do that, but you still are not familiar with the M&A process. So you need to have somebody beyond the lawyer to be able to kind of give you a sense of, the nuances of the marketplace and, some sector expertise to kind of help you figure out who the right buyer is before your lawyer starts working on the agreement. And tax and accounting, we fill in two different buckets. One, the accounting side, because that financial person is going to have to be able to kind of prove out what the revenues and the adjusted EBITDA or earnings before interest, taxes, depreciation, amortization are. And then there's adjusted because they're going to adjust for owner economics, for whether you own your building or not, whether you take distributions from your business or not. So that adjusted EBITDA is probably going to be the basis for your purchase price. It's going to be a multiple of that number. So you need strong accounting. And, for most people, they're going to want tax planning. They're going to want tax advice. If it's a C Corp or an LLC or an S Corp, the decision about the buyer deciding that they want to do a stock purchase versus an asset purchase has different tax implications for you, the seller. So you're going to want to get good tax advice. To some extent, if you've got an M&A lawyer who's part of a firm, it won't necessarily take, a whole nother firm or a lot of other resources. You can probably get that stuff done fairly quickly. But, depending on whether it's going to be an all cash transaction or cash and structure or cash and stock, there are some decisions that can be made around tax that can minimize the burden to you or things that will dramatically impact what your net proceeds are. The other here is interesting because the other includes wealth advisors. I find that wealth advisors who understand the M&A process can really help you to figure out which of the offers matches up with your why, especially if you're not including a transactional professional in there. The wealth advisor can not only do capital sufficiency analysis to sort of say, if your net proceeds are going to be X and we think expected returns are going to be Y, does this deal get you where you need to go? But also gives you opportunities to look at planning for minimization of taxes, minimization of income taxes, capital gains taxes, and then estate taxes, right? So the other is most commonly a financial advisor. Every once in a while, it will include an insurance professional, and it might include some other consultants. So we can take that in Q&A if it comes up. So here's a couple of things that may seem intuitive or obvious, but I'm going to state them because they need to be reemphasized. So first of all, if you retain good M&A counsel, you retain an investment banker, you retain a transactional professional, you get accounting and tax support in there, take the advice that you're paying for. Don't argue with the market, don't argue with your advisors, and don't negotiate with your advisors. Your advisors aren't the market. They're trying to deliver to you that which the market is going to communicate or offer up to you. So, what we see people do often is disregard the advice that they're getting from the people that they've hired because it doesn't track with what they want to be true. And that causes everybody to be frustrated and nobody gets to where they need to go. So if you've sourced your advisors from the right places, it's fine to continue to use your own instincts. I mean, you built a successful business, continue to use your own instincts, but don't ignore the guidance of good advisors. Even if it is, to say, well, on average, people do this, or I've seen most people do this, but you can certainly try these things. But make sure you absorb at least all of the advisory experience you're getting. And critically, remember your why. Now, this one sounds crunchy, but it's really very practical. Like, look, if your desire is to get as much cash as possible at the close and ride off into the sunset, but you can tell by the private equity buyer's offer for your business that they want you to stay around for 5 years and participate in what they're going to call the second bite of the apple. And they're going to use their capital, their strategic guidance, their operating expertise for the two of you to head towards that second bite of the apple and make a lot more money in that second sale. Remember your why. If your why is, I want to get the heck out of here, I am so sick of this, I'm counting the days. Trust me when I tell you, you're not going to be able to spend 15 or 1,600 more days doing that, no matter what kind of chunk of money you get to take assets off the table. On the other hand, if your why is, well, I'd like better financial partners, I would like to have a little less of the responsibility of having all of this on my shoulders. And I'm stressed out that it's on me to keep paying for 100 people that work for me and figure out what the next thing is. Well, in that case, then maybe that private equity buyer who wants to inject capital and bring in their other resources and relationships to help you build towards the second bite of the apple is exactly the right buyer. So remember why you're doing what you're doing, right? And along those lines, you structure your advantage, right? And what I mean by that, in the M&A world, anything that's not cash is referred to as structure. So if you're taking back a note, like, the buyer offers you $20 million for your business and they're going to give you $10 million in cash and have you take back a $5 million note and roll over $5 million of your equity into the second sale down the road. All right, the $5 million note may pay cash or it may just accrue interest. It's going to bear some interest rate. That structure might play to your advantage. If you don't have to, if you only have to pay taxes on the 10 million you got up front and you were going to reinvest money or have to stop taking distributions so that, your new buyer can kind of participate with you, well, the note might replace some of the distributions you were taking. So go ahead and use that structure to your advantage. Make sure that you get what you need out of the deal. Don't go from paying yourself $250,000 a year in salary and taking $750,000 in distributions out of the business and think that you're going to be able to then all of a sudden work for a market rate salary of $250 because your new buyer is no longer going to let you take distributions from your business because they want to leave those in the business. And now all of a sudden, your lifestyle has to change dramatically and you have to start immediately pulling from the proceeds they just gave you to supplement your lifestyle. Use structure to make sure that things line up with your why. Let's go ahead and move forward, Marcia. So whenever we do these events, whenever we do live events, when we speak to Vistage groups, YPO groups, entrepreneurs organization, Renaissance Executive Forum, the biggest chunk of questions come around like, what are the biggest mistakes sellers make? So we include them right up front here. I mentioned it before, seller expectations. Having expectations is not the mistake. It is believing that because you need $20 million on a net after tax basis to be able to support the lifestyle that you want to have, that you now believe that your business is worth, $35 million in order to get you to the $20 million. Your business is going to be worth a multiple of its ongoing economics, increased by the likelihood they will grow or persist, and decreased by the likelihood that something is going to change about them going forward, either exterior factors or, things going on inside the business, right? And the market gets to decide, right? So you can decide to walk away from a potential transaction. You can decide to build more EBITDA. If the market, if your business generates 2 million of EBITDA and average market multiples in your sector are 7 or 8 times, then look, 14 to 16 million bucks is what your business is worth. If you feel like you need 20, well, then you need to grow your EBITDA to get to where, that 6 or 7 times or 7 or 8 times is, kind of in line with what you need. You don't get to argue with the market. The market is what the market is. You can use your transaction advisors to try and drive prices higher, especially if you've got a good investment bank that can get a strategic buyer to be, in a bidding war of sorts with a financial buyer to drive that price higher. But once the number's there, and you'll find that the letters of intent when they come in, that the range of value is usually not that huge, right? The market generally agrees on what's a market rate deal. If you can't accept it and you argue with it, it's going to be disappointing for you, going to be disappointing for your advisors. Then the other piece too, and this happens more frequently you might think, is a couple of things. One, in due diligence, when people ask you for outstanding legal activity, outstanding HR problems, problems with competitors, problems with ex-employees, whether your EBITDA is legitimate and it's been audited, and whether cash flows through the business the way you've represented it as they go through due diligence. When they ask you those things, remember that there is no such thing as, geez, my bad, first time seller, I didn't know you meant that literally. You're going to sign something that's called reps and warranties, or representations and warranties. And if you sign that, knowing that the information you presented is some version of the truth, but not the, actual truth, you've just committed fraud. So it is up to the buyer to uncover things in due diligence that they need to know more about. But you have a responsibility to disclose information that they've asked for, even if it means, and this is usually your fear more than reality, but an experienced advisor can tell you this, even if it means the buyer might not move forward. It's been my experience that between a willing buyer and a willing seller, structure can fix everything, right? So if the buyer finds out something in due diligence that makes them feel like they have to underwrite the risk of buying your business differently, chances are there's a way to fix it. Chances are, if you're open to it and you've been authentic in the process, we'll work out something through structure. But if you've withheld information and you have to kind of go, yeah, you got me, that's not legit, expect for them to walk away. They probably should. So, just don't withhold that information. And then lastly, and this is another reason that, it's useful to have experienced advisors, this process is going to wear you out emotionally, physically. It's going to tap your resources. You're going to get what is referred to as deal fatigue. And the critical thing to understand about deal fatigue is faster sale processes favor sellers. Longer sale processes favor buyers, right? So you want to move as quickly as you can, but you also want to make sure that your buyer gets the information they have. But understand that they have, they can take longer to wait to pay you and not have any less interest in buying your business, knowing full well that at some point you'll be a little bit fatigued and will eventually say, okay, fine, go ahead. I can live with that, and I can live with this change, and I can live with that. That deal fatigue is going to impact you. So if you lean on your advisors to compensate for the deal fatigue and to let them take some of the burden off of you and to reflect back to you what's reasonable and what's not, then you're much less likely to suffer a worse outcome because of the deal fatigue. So those are kind of a couple of the key kind of mistakes and pitfalls.
Okay, great. Kirk, very good information as always. It's so important to have someone with true transactional experience who aligns themselves in a way they sit on the same side of the table. I think that's why, same thing in wealth management. It's just really valuable to have experience that's aligned with the decisions you're going to be facing. It's kind of you against the world as a seller oftentimes. So getting into some of the questions, we work closely with business owners for a variety of reasons. There's a lot of value that you can add. What we find, our business owners are so busy running their business, which is their biggest asset, they often neglect and leave, perpetually their personal wealth chips on the table. So that's kind of where a wealth manager comes in. At what point do you see yourself as an advisor needing to come into the picture?
I think that the inflection point is, kind of two different places. So if you get an unsolicited offer from a potential buyer, and understand that that offer is not going to come through a decision maker. It's going to come from, an analyst or associate or vice president of a private equity firm or a corporate development person at a strategic buyer. And they reach you out of the blue to tell you that they think your business looks like it's really valuable and they'd like to chat with you about selling. It's critical then to call us or someone like us to say, what kind of information should I provide to them? And when can I ask them how much they'll pay? And how can I kind of stage or control this process? Like what's normal? And whether it's us or, an M&A lawyer or an investment banker, they'll get good guidance on that. The other time it happens is if somebody's thinking about selling, and whether it's, in the next 3 to 6 months, or they're thinking that they want to maximize the value of their business for a sale 2 to 3 years in the future, That's when people usually call. And it's almost always that far apart. That somebody's kind of recognized that they need to build some value in their business, and they're thinking they want to retire in a few years, or they're thinking they want to sell and do something else in a few years. We get a lot of those calls. So it's a long-winded way of saying it happens a few different times, but it's just a few specific inflection points.
Okay, great. Along those same lines, how important do you think it is? How often is it a single unsolicited buyer? And then how important is it to try to go get a second sense of your valuation in the marketplace? Because that's what I see a lot with my existing clients, is it's not necessarily a private equity buyer. It is a strategic, it's the director of M&A or the person developing those transactions, and they're quick and they're aggressive. So how important is it to get kind of that second bid in the market?
Yeah, that's a fantastic question. It's a hard one look, if you're a successful founder and somebody calls you out of the blue and flatters you about your business and then starts talking in terms of a price or a range that kind of hits what you think is your number, it's really compelling, it's flattering, it's exciting, and you go home and you tell your partner that this is happening, and you want to immediately comply with their, the potential buyer's request to provide them not only with your most recent financials, usually after they've, asked you to sign a non-disclosure agreement, or you've had the foresight to ask them for a non-disclosure agreement, but you tend to want to provide them with financials, and you think, well, I don't want to chase them away, right, by having my lawyer get involved or an investment banker get involved or some other transactional professional involved. And I'll tell you that in 10 out of 10 cases, you should involve somebody with some transactional experience. You will not chase away a truly interested buyer who was willing to pay a market price for your business. If you involve a transactional professional, you will chase away a predatory private equity firm that wanted to buy your business really, really cheaply and was hoping they could do it without you having professional advice. You will chase away a strategic that's just kicking tires and wants to see what's available out there and who opportunistically is willing to sell to them. You will chase away independent sponsors who don't actually have any capital, and they're looking to tie up a prospective founder so that they can put together some deal so they can earn a living by buying your business, by going out and convincing a source of capital that they've got your deal all locked up in a buyout arrangement. All of those people get chased away by transactional professionals. But let me tell you that unless you don't have any other options, that's not who you want to sell to anyway. I'll just make the extreme statement. In every single case, invite a transactional professional in to at least say, is this a market kind of level transaction? Are these reasonable terms?
Got it. And continuing that dialogue, how do you spot a good or poor advisor? How do you determine that someone's the right fit, both at your level, which is really quarterbacking the situation if necessary, or at the underlying specific expertise level, CPA, investment banker, et cetera?
So look, if you're talking to somebody who claims to understand the M&A process and encourages it to go get either your intellectual property or your company professionally valued before you start evaluating the potential for a transaction, that's not an experienced advisor. Most investment banks will give you a sense of a range of valuation for free just by talking to you about the potential opportunity to sell your business. If you're talking to someone who uses a lot of kind of the right phrasing of M&A, but when you start asking about their specific experience, seems to be talking continually about a deal, it's fine to give anecdotal information. But if your advisor hasn't worked on a lot of deals as part of a bigger group and or then, a smaller group, look, there's plenty of advisors who have. So, we all want to give somebody a break and we all want to spend less money if we can. But I mean, the reality is, I'll tell you that, if you end up paying, let's say you've got a $20 million company and you end up paying your M&A attorney $250,000 and you end up paying your investment banker, $800,000, you will consider it money well spent. It may not sound like it now, but by the time it's all done, you'll consider it money well spent. And most poor advisors just haven't worked on enough transactions or overplay, their expertise. And then the other thing I would say is that to spot a good advisor, just ask them about their experience.
Is it important to have a sector specialist?
So it kind of depends on your sector. If you're in manufacturing or consumer packaged goods or, an area that I would call kind of broadly business services, then you probably don't need a sector specialist. You just need good M&A professionals, good deal people. If you're in healthcare, especially if you're in life science or pharma, then firms with that specialty are important. If you're in an area that takes a fair amount of both data science and specific, insider knowledge, like maybe AR, VR, certain kinds of software, then sector expertise is going to matter. So it kind of depends. For most businesses, just a good advisor, especially in the middle market, call that anywhere between, the lower middle market being, call it, 10 to 75 million of enterprise value, and the middle market, call it, between 75 and 250 million of enterprise value. In most of those transactions, unless they're, like I said, in healthcare, life science, or certain areas of technology, just a generally good deal professional is going to fit. And if it's a firm, like, if there's a dozen people in an investment bank, they're going to have sector specialists anyway. So it's about the firm and whether they have a good reputation, they tend to close transactions, and they tend to price their services fairly.
Okay, great. And then getting back to the assembling of the team, what is sort of I'm sure it depends on the complexity and the challenging elements of a transaction, but what should someone expect to pay when they assemble a team and go through the transaction? And is there anything people should really look out for in those negotiations, specifically with an investment banker, so on and so forth?
Yeah. So, look, these are reasonable questions to ask of everyone who's involved. So don't shy away from them. If you're, if you're a founder thinking about selling, ask people how they're compensated, who pays, kind of for what they do. If you're retaining an M&A lawyer, ask them how much they think it's going to cost. That's probably going to be a function of how large and complex the deal is. But if they say, let's say you've got a $50 million business, it'd be reasonable for the M&A lawyer to say it's probably going to be somewhere between $200,000 and $400,000, depending on whether your buyer and or you have a lot of back and forth on the negotiations. A lot of the reasons that M&A law firms or M&A lawyers end up costing more have nothing to do with a lawyer's hourly rate. They have everything to do with tough negotiations around a working capital adjustment, tough negotiations around, kind of what the expectations are of you after the sale. So, ask them, don't ask, you can ask their hourly rate, but the more important consideration is how much do you think it's going to cost me? And then investment bankers, still have what's called the Lehman Scale, and it's a percentage of transactions. So even though Lehman died, this persists. So in small transactions, call it below $10 million, business brokers and the low end of investment bankers can charge as much as, 5 to even 10%. So 6 to 7% would not be odd in a small transaction. Now, if it's a business broker and they're just handling paperwork and they're not really finding you the buyer, then they shouldn't be charging anywhere near that, right? They might get a couple of percent, but they're definitely going to take a percentage of the transaction. If it's call it a $50 to $250 million deal, then chances are the investment banker is going to charge somewhere between 1.5% and 3%, and they'll usually charge it on ratchets. So it would be, kind of maybe 1.5% to $50 million if the expectation is that your deal could sell for over 75. They might charge their lowest percentage up to a number that's below what you'd really think you'd accept. And then a higher percentage, say, let's say 2.5% from 50 to 75 million. And then if they exceed your expectations, an even higher percentage, right? So on a deal I'm working on right now, the investment banker initially pitched a 3.5% fee flat across, whatever size transaction. And they had given us a range of valuation from 125 to $200 million. And so we came back to him and said, we'll pay you 2% to 125. We'll give you 4% on anything above 200, and we'll give you 5% on anything above 250, right? So we wanted to incentive our investment banker to get us a ridiculously large amount of money for the business, and we wanted them to make a whole lot of money. We didn't want them to be, happy with a $150 million deal where they made 3.5%. Because even though they, would have made a lot more money with 3.5% of a $250 million transaction, a lot of times the investment banker, hits a number where they know it's going to take a lot of additional work, or they're potentially going to chase away, the buyer with extended negotiations. And they'll think, well, 3.5% of 150 million bucks, pretty good payday. We ought to be able to get this one into diligence fast and work on some other deals. We'd rather have the investment banker that wants to, kind of represent our interests, but take the risk that to earn a lot more money themselves, they're going to have to get us a bigger number, right? So the investment banking arrangement is usually a pretty pure alignment with, with your interests or your objectives. And then the other transactional professionals usually charge, like our firm charges fixed monthly consulting fees, because you're paying us for our judgment, not our time. Some management consultants and other transactional consultants will charge, an hourly rate plus a percentage of the deal. We'd rather not. It's not that we don't care, but we would rather not be incentivized to get the deal done. And what I mean by that is oftentimes we're brought in to assess an existing offer from an unsolicited buyer. And if we charge the percentage of the transaction, then we'd have every incentive to greenlight what might be a bad deal, something that doesn't match up with your why. So our viewpoint is we shouldn't be incentivized to get the deal done. We should just be paid for our experience.
We do have a question. I believe it's around, suggestions for employee-owned companies. I can tell you from a wealth management perspective, an employee-owned transaction does have a lot of advantages from a tax deferment, tax structuring point of view. But Kirk, do you have any specific thoughts on, and do you advise upon employee-owned sales?
Yeah, we do. It's a great question. So there's a couple of things, so we probably talk about 20 ESOPs for every one that we see get done, but it's definitely something that might be investigated, because to the point I think you were making, Andrew, there can be significant tax advantages and even other legacy advantages to selling to employees. And there's bank financing usually available. So depending on whether your price in a sale to an outside buyer would get you to a number that you need to be able to do, on a net after tax basis, what you want to do for the rest of your life, the ESOP might actually, on a net after tax basis, be better, especially if the business wouldn't be that highly valued by an outside buyer. So businesses like, architecture firms, construction firms, some other professional services firms, consulting firms, they tend to be better ESOP or management buyout candidates than outside buyer candidates because there's usually not a high multiple of EBITDA paid for those businesses because they're project-based, right? So for project-based businesses, employee ownership will often make a big difference. And there can also be an outside sale down the road of an employee-owned company. I've participated in deals where 65% ESOP owned. The founder of the business thought that eventually his employees would buy the other 35%. A buyer came along and was interested in the business. And, the employees and the founder thought it was a win because from the buyer's perspective, he got the number that he wanted. He just had to write 2 checks to close the deal, one to the ESOP and one to the founder for the remainder that he still owned. But it doesn't get in the way of being able to sell the business if, you sell a percentage of the business to your employees, especially because of the tax advantage.
Sure. Yeah, I believe even with if you get a loan to fund those ESOP payments, essentially, there's potentially deductible interest as well. But I think it creates a tremendous amount of optionality to retain part ownership, gradually reduce your involvement, and it makes a lot of sense for a lot of companies.
Yeah, and I'll throw in one other thing, which is that it can be a really useful way to retain key employees to share in the ownership of the business. But there too, you need to be thoughtful about that. If you got a key staff member who you can never pay really big money, but they're vital to running the business, then maybe some ownership makes some sense. On the other hand, don't make your number one salesperson who's being compensated with commission in addition to whatever their salary is also your largest shareholder, because that person then kind of controls your business in 2 different ways, right? So the nicest thing to do with employee ownership is to kind of level things out in such a way that it incents everybody to want to build the value of the business. And there are some great ESOP consultants around that we use. Here locally connected to the University of San Diego, there's the Beister Institute. Bob Beister founded a company called SAIC here in San Diego, really large defense aerospace company that he eventually sold to employees. So the Beister Institute has consultants that work on ESOP transactions, and ESOP consultants don't charge that much money. And then there's independent ESOP consultants who can evaluate, what the likely market is for the business and how you put together an ESOP. And they, like we, have lots of financing sources. So it's a worthwhile thing, especially if it's project-based business, to look at employee ownership.
Well, I think that's about all the time we have for questions. I want to go ahead and thank both Andrew and Kirk for being here. Andrew, I'm glad that the technical issues were resolved so we can have you on here. And once again, you're welcome. Once again, from Advice Chaser, thank you so much for attending, and thanks to the organizations that have made this webinar possible. Here at Advice Chaser, we're all about helping you find an advisor who's a great fit for you, your life, and your financial questions. Our matching service is free to you, and every one of our advisor partners has offered to a free consultation to anyone we match them with. Just go to advicechaser.com and click on the link to find an advisor. Once again, from Advice Chaser, thank you so much, everyone, and we will see you at another webinar soon. Bye, everyone.